$38 billion. That's the infrastructure deal Amazon just inked with OpenAI for AWS computing power. According to sources familiar with the negotiations, this represents the largest AI infrastructure commitment in history. Amazon's stock sits at $244.35, up on the news. But there's a bigger story here about the AI infrastructure arms race now reshaping entire sectors. We're witnessing the shift from experimental AI to production-scale deployment. Think Netflix's server build-out in 2010, but compressed into months instead of years. Amazon's Project Rainier alone requires over 500,000 Trainium2O chips. That's Amazon's custom AI processors designed to compete with NVIDIA's dominance. Microsoft Azure is racing to match this scale. The cloud infrastructure spend is exploding because every Fortune 500 company now needs AI compute power, not just AI experiments. Now watch these numbers carefully. NVIDIA closed at $1,134,333. That's actually down 7.13% despite the infrastructure boom. Why? China export restrictions under Trump's advanced chip controls are creating uncertainty. Amazon's moving 200 million shares in average daily volume, signaling institutional repositioning. The AWS Graviton 5 processors, Amazon's latest chips, represent a direct challenge to NVIDIA's data center monopoly. But here's where it gets interesting. OpenAI separately held discussions with Amazon to raise at least $10 billion additional funding. Translation: they need even more compute power than the $38 billion deal covers. Microsoft's response: they're doubling down on their OpenAI partnership while building competing infrastructure. The semiconductor supply chain is getting squeezed from both ends. Massive demand growth, but geopolitical supply restrictions. This is the part most people miss. The infrastructure winners aren't just the obvious chip stocks. Amazon's Trainium2O strategy could capture 15–20% of AI training market from NVIDIA within 18 months. That's billions in revenue shift. Cloud stocks are the real beneficiaries. Oz, Microsoft Azure, Google Cloud all seeing enterprise customers commit to multi-year AI infrastructure contracts. Risk factor: China export restrictions could disrupt 30–40% of global semiconductor supply chains. If you own semiconductor ETFs, you're exposed to both the upside of AI demand and the downside of trade tensions. From an investment thesis perspective, we're seeing infrastructure spend pull forward from 2025–2026 into 2024. Amazon's vertical integration strategy, building their own chips instead of buying NVIDIA's, creates both opportunity and risk. Opportunity: better margins on AI services. Risk: execution complexity in semiconductor design. Key metrics to watch: Oz revenue growth, NVIDIA data center revenue, and Microsoft's capital expenditure on AI infrastructure. The contrarian view: this infrastructure build-out could be overinvestment if AI adoption slows. Remember the fiber optic boom of 2000? Massive infrastructure spend, followed by overcapacity and crashes. And here's the kicker: what if enterprise AI adoption doesn't justify this infrastructure spend? Companies are committing billions to AI compute before proving ROI on AI applications. Amazon and Microsoft are betting their infrastructure lead will lock in customers. But if the AI productivity gains don't materialize, these contracts become expensive overhead, not competitive advantages. The bottom line: Amazon's $38 billion OpenAI deal signals infrastructure is the new battleground in AI, not just algorithms. Winners will be cloud providers and custom chip designers. Losers could be companies overpaying for NVIDIA's premium while alternatives scale. Watch Oz revenue growth and semiconductor trade policy. They're your leading indicators for this entire sector.